Welcome back, everyone. Welcome, my dear students. Another lecture on the journal adjustments, journal entries adjustments. And today we'll talk about the adjustments which will happen, which will occur in the trial balance. On the trial balance, how and what are the adjustments should be done. Any adjustment should be done will be registered here. So like this now, we have example here, given the example, giving the following data, and set the adjusting journal entries. We will set the journal entries for the following. This is the unadjusted trial balance. That's the first one, the origin. Before we settle the transactions, here are the sums of the transactions which happened. And we'll do the journal entries for these transactions. Then we will adjust the trial balance. So the question is here, giving the following data. The following data is this, the adjusted trial balance, unadjusted trial balance, and the transactions. Then I can do it better like this to be shown up better like this. Here, giving the following data. I will take this part. This is the following data which is giving, and the part of the transaction which is giving. Then required, I will put the required here so it will be clear more to my dear students than how it looks like before. It will be more clear here now. So here, let's make it in black color. I don't know why it doesn't want to move in black color. That's fine, no problem. It's okay. Maybe if I move it just a little bit down here, like this, still realize like it doesn't want to work. No problem, it's okay. However, I have now adjusting entries, and I have unadjusted trial balance is given to me in the question, like you see here now, given the following data. We have unadjusted trial balance, and we have also the adjustments for the journal entries for the accounting records that occurred within the period of time. Then we need to do this to set the adjusting entries, like to do the adjusting journal entries. Here we go. And the second thing, we make the adjusted trial balance as well. So we'll set the adjusting trial balance. So we'll set the adjusting journal entries, and we will do the adjusting trial balance on 31 March 31. So first of all, I have here already the origin. I have the trial balance before adjusting. Those are the numbers: cash 80,000, inventory 400,000, account receivable 112,000, and so on. And I have also, these are the transactions which occurred in this period of time. Now let's see first. Rent for April paid during March is 10,000. Rent for April paid during March. Okay, this means the April paid during March. So I will do the first entry here because this is prepaid. So I paid in March. But it's due on April. It should be due in April. That means that I paid in advance. I paid $10,000 in advance. Again, I'm saying, now I paid on March, but it should be paid on April. Okay, when I tell you now, you pay now, and or you pay after 1 month, you would say, no, I will pay now. So you paid prepaid. Prepaid means the rent of April, you paid it in March, which is prepaid. For that reason, we go for the first journal entry here, and it will be from prepaid rents into cash with the amount of 10,000. From the prepaid rent into cash with the amount of 10,000. Okay. So let's go back. Sorry about the disturbing voice, guys. So rent for April paid on March is 10,000. Here we go. The 10,000, you will say, no, you paid. So the cash will be credit. Credit was 10,000. and the prepaid rent will be debit. So prepaid 10,000 into cash 10,000. I'm here in this transaction from prepaid rent to cash, from prepaid rent into cash. Prepaid rent is 10,000 into cash 10,000. Okay, how this will affect on the balance sheet, on the trial balance? Let's see here. There is prepaid rent expenses 50,000. Let us go and see. There is prepaid rent. Okay. How I will adjust this now? I have to add 10,000 as a prepaid rent. So here I will go here, check out. There was no prepaid rent article first. Then I will add this 10,000 which happened right now, this 10,000 which happened right now, and I will make an article items called prepaid rent. Watch out. This is not the rent. This is prepaid rent because we have in the origin, there is rent already. We have rent. So we don't mix them. We don't mix. We have rent expenses, 50,000. We don't mix the rent with the prepaid rent. We make the rent alone and the prepaid rent alone. Look at this here now. Look at this here now. Let's go down, 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 down. Rent expenses, 50,000 as it is. But we made a prepaid rent, like you see here. Let's go for it. It was in my hand right now. Here it is. Prepaid rent, here it is, prepaid rent 10,000. Okay, guys, so don't mix the rent and prepaid rents. If there is no prepaid rent on the origin, or the adjusted trial balance, then make an article, make a row that is called prepaid rent and put in it the amount. So this was the first transaction. Let's say again, let's make it again. Here, the origin, the data given, and here are the transactions. I went for the first transaction. First transaction is telling me rent for April paid during March, 10,000. Okay, so I paid on March in advance, the rent of April. So that means that I paid prepaid rent. So I will make the entry for this. That was on 31 March, date 31 March. I paid prepaid rent into cash, from prepaid rent into cash. The amount is $10,000, which is paid in advance. Okay, then for the adjusted trial balance, I look if there was a prepaid rent before. Here we go to the unadjusted one, the origin. If there was prepaid rent, there is no prepaid rent here. So I have to create it. But if there was prepaid rent, I will add what is in the journal entry to what is here. But actually, there is no here prepaid rent. For that reason, when I make the adjusted trial balance, I will make a column or a row. A row is called prepaid rent, like you see here, prepaid rent. 0 is the origin, because there was no prepaid rent, plus the 10,000, which I had it here from the prepaid rent into the cash, 10,000. So I add the prepaid rent, which was 0, because I had no before, plus the 10,000, which I had just now. So it will be 10,000. Of course, the prepaid rent is always debit, prepaid rent. So I will put it here because it's debited, it's not credit. So I put it in the debit side. And you can see it also from here, from prepaid rent. So it is debit here. So it will be debit in the trial balance as well. It will be debit in the adjusted trial balance, Good. That's nice. Let's go now into the second part, which we need here. Let's go to the second part, which we need here. And the second thing, or the second transaction, which we need to know about this part. Due date or day due of electricity bill for March is April 5, 35,000. Due date of electricity bill for March is April 5. So the due date is April 5. Come, let's see what did we do in this transaction. Here, from electricity expenses account or electricity expenses into accrued expenses. into accrued expense, because this means that I didn't pay it. I didn't pay it yet. This means I didn't pay it. So here, the meaning of that, it's opposite of the first one. The first one is a prepaid, but the second one here is accrued expenses. Accrued expenses means I did not pay it. So I got the services, but I did not pay the 35,000. Now I will go here and say from electricity expenses 35 into accrued expenses of 35,000. Now I have to go and look. Was there any electricity expenses or accrued expenses in the trial balance? And see. Let us see. We have here electricity expenses, yes, 35,000. 35,000. Okay, so I have in the journal entries electricity expenses 35,000, new 35,000. Now let's go into the trial balance, the adjusted trial balance, and see. We had here, let us see, rent expenses, salaries, electricity expenses. There was 35,000, like we said before, plus the 35,000 which happened from this transaction. Here, I'm talking about here. Let me take electricity expenses. 35,000 old and 35,000 came from this transaction. We had 35,000 from electricity into accrued expenses, 35,000. And there was already in the old trial balance, there was electricity expenses 35. You guys can see it. Electricity expenses 35,000 here. So what I will do then, I will add the old one to the new one, and I will put it in the new journal or in the new trial balance. So here I have it here. Electricity expenses 35,000 plus 35,000. That will give me 70,000. Of course, it's debit because always any expenses will be debit from. So 35 old and 35 new, that will be 70,000. Let us go and now see, we have also another part of this, because we have two parties, the debit and the credit. How about the accrued expenses? I have to go first and see here in the old one. If there is accrued expenses here, let us go and see. Slow down. Accrued expenses. Actually, there is no accrued expenses here. There is no accrued expenses. When we come to see, there is no accrued expenses. We have cash, inventory, account, loan. We don't have accrued expenses. So when we do the new trial balance, let us see now, there is accrued expenses. Yes, accrued expenses will be 35 plus 50. The one of them is coming still, but with the first one is 35, which we did now, the second party. So we have here this 35,000, and here in the accrued expenses 35,000. Still, we have one more will come in the transaction right now. So till the moment, it's only 35,000. Please wait. Okay, guys. So we have now 35,000 for the moment. We'll see what this 50,000 is coming from the next transactions. It will come from the next transactions. Okay. So this was the second transaction. Third, a customer made some payment in advance. This is unearned revenue. We call it unearned revenue. So a customer made some payments in advance with how much? With 10,000. This we call it unearned revenue. So in that case, unearned revenue 10,000, unearned revenue 10,000. Here we go to the following. We do the following: unearned revenue. So we'll go to the transaction 3 and see. We received cash, right? Because this 10,000 unearned revenue means what? That the client tell you, take the money for the service which you will do to me. Take the money for the service that you will do to me. And I am expecting to have this service later, but take the money now. So you took the money in advance, but you didn't work with this money. You didn't do any effort with this money. For that reason, you took the money increased, so it will be debit cash into unearned revenue, So from 10,000 into 10,000. Wait a minute. We have to go and check now the two parties, 10,000 for the cash and unearned revenue. Okay, there was in the cash here, when we come to see, there was in the cash 80,000. Now we have to increase the cash also with this 10,000, which is an earned revenue. So here in the cash 10,000, we have to increase it. So that will look at this cash 80,000 plus the 10,000, which we earn right now, unearned revenue. This one, please, this one will come later on. We are just now for what we register now, because you will be working at the same time, adding and subtracting at the same time. So 80,000 was origin here, here. There was 80,000 already. That's the cash, which has already. Then plus now, plus the 10,000, which come to you here in the debit. 10,000 debit now. Okay. Okay. So here now, you will do this transaction. It will be 80 plus 10,000. Let's wait and see what is the 10,000, because he will pay later on, right? So he deducted with the cash, so the cash will be deducted. But let's say now this one 80,000 plus the transaction of debit, which is 10,000. Okay, this is the first from cash to unearned revenue. Let us see now. Unearned revenue is 10,000. Let's see, there was unearned revenue here in the origin, in the old trial balance. There was unearned revenue. Let us see. There is revenue, but there is no unearned revenue. There is no unearned revenue. There is no unearned revenue, but there is revenue. Okay. Then we will go now for our new trial balance, adjusted, and we will see unearned revenue. Here it is. There was no unearned revenue, like we said in the old, so we put 0. Plus, what came to me from this transaction? From cash to unearned revenue, 10,000. Then I will add this 10,000 here for unearned revenue. Then all will be how much, guys? 10,000 plus 0, there will be 10,000. Take care, because unearned revenue is credit here. It's credit, because here we say to unearned revenue, which is credit. So 10,000 is credit. So I put it here in the credit side. Perfect, cool. This is the unearned revenue. Okay. Next transaction. We'll go now into the next transaction. 4. A customer of Alibaba gone bankrupted. Gone bankrupted, that means bad debts. Bad debts means no way. This money is gone. This money is gone. I won't be able to get it back. I won't be able to get this money back. It's called bad debts or bad debts. Bad debts. Amount becomes irrecoverable means from this customer. Okay, then we go here now and do the bad debts. The bad debts will be from the bad debts 50,000 into the account receivable 50,000, because actually this was from the account receivable to the client. But now I will close the account receivable, which is always debts. This is the first time to do it credit. Always debit, but this time is the first time for me to do it credit. The reason, because I'm canceling the transaction. I'm canceling the transaction. So from bad debts into account receivable. That's how much, guys? 50,000. Then I have to go and check out. Do I have account receivable? Notice that each entry has two parties, one debts and one credits. For that reason, we have to make sure that the effect sounds here in the trial balance, and in the two parties of the journal entries are sounding here. So here, guys, now I will go into a customer of Alibaba, this bankruptcy, 50,000, and we know how to do it from the account. We'll do it like this, from the bad debts into the account receivable. Now I just want to see if there is here bad debts. There is bad debts. Let us see in the old one. There is bad debts, because if there is in the old one bad debts, I will add the old bad debts to the new bad debts. I will add both of them together. So I will have cash, inventory, account receivable. We are looking for the bad debts. Revenues, cost, nothing. No article is called bad debts here. I'm talking about the adjusted mean the old one. So I don't have here. I don't have it here. I don't have it here anymore. So guys, that means that I have to create now in the new journal entry. I have to create a new article. It's called bad debts. Let's go here. Here it is, bad debts. Can you see it, guys? Bad debts. Here it is, bad debts. It was zero. Zero in the old means there is no here. In the old trial balance, in the old one before the adjustment, there is nothing is called bad debts. So here I will put zero, like you see here in the bad debts. I will put zero plus the bad debts which came from the transaction. So here in the bad debts, from bad debts to account receivable with the amount of 50,000. So here there will be 0 plus 50,000. Here we go to the bad debts again. Bad debts here 0 because there was no any in the old trial balance. There was no any accounts or any kind of money in the old trial balance. But the new trial balance will include 50,000 as bad debts. So 0 plus 50,000, that's all comes to 50,000. That's come to 50,000. So the new trial balance will include 50,000. Okay. The next one now, the next one is here. So this is from the bad debts. What about the account receivable, guys? Because it's from the bad debts into account receivable. We'll see the account receivable. How far it has account in the past? It has any kind of balances? Let's see. Account receivable was 112. Account receivable in the old before. This is the old. Unadjusted means the old. So account receivable here has 112,000. Cool, guys. Then I had also 50,000 came to me here. I had also 50,000 came to me from bad debts to account receivable 50,000. Let's see now after the adjustment. Remember, there was 112 and this is now 50. We have now new 50. There was 112. Here it is. Just to remind you. Here it is. Account receivable 112. And now we have extra 50 come to us from the transaction of the bad debts to account receivable. Let's see now the account receivable. Look at this. Look at this. 112 minus the 50,000. Okay, guys, 112 minus the 50,000. Like you see here, because two account receivable. So two account receivable means it's a credit. So I have to minus it here. Minus it here. So 112 minus 50,000. So the new current will be debited with 62,000. Minus because I'm not able to get it back because it's gone. I had 112,000, 50,000 of them are bad debts, means I won't be able to collect them. So I have to deduct them from my accounts. So only left for me and the clients who bought from me and did not pay yet are 112,000 minus the 50,000, which is lost, which is gone. So only the clients which I will get from, I will get 62,000 only. That's the meaning of account receivable. Only I will get, okay. Let's go to the next transaction here. And the last one. Salaries for previous months paid for the 5 on the 5th of the next month is 50,000. Salaries of the previous months paid on 5th of the next month is 50,000. Let's go here now and see what is this. This is accrued expenses. So from the salaries account, 50,000, from the salaries account, 50,000 into the accrued expenses again. From salaries account, 50,000 into the accrued expenses. Now we'll go back and see if there is something for the salaries here. Salaries was 25,000. Salaries was 25,000 in the old trial balance. And now we have here in our journal entry from salaries account into accrued expenses, 50,000. So salaries, let's go for the salaries now. Let's go for the salaries. The salaries included 25,000 in the past, plus the accrued expenses of 50,000 So here, that will equal 25,000 plus 50,000. It will come to 75,000. 75,000. So here, this is the, but the other side also, we have accrued expenses, the 50,000. So we'll go to the accrued expenses. We'll look here for the accrued expenses. If there was accrued expenses, we have account receivable, account payable, dividends, revenues, cost of goods sold, rent expenses, salaries. We don't have accrued expenses. So we have to create accrued expenses. Accrued expenses. Let us see here. Total cost and earned revenues. Accrued expenses. There was 35. You remember when we talk about the 35, which came from these transactions, accrued expenses, 35, the old one, this one, 35 plus this 50. So 35 plus 50, it will be 85. Here it is. 35 plus 50, it will be 85. Of course, it's credit because the accurate expenses is credit. Credit means I have to pay it. Debit means it's mine. Credit means I have to pay it. Remember it from the credit card of the bank. The credit, when you have a credit card, means that you have to pay. So here, 35,000 plus 50,000, 85,000. Now we will do the new trial balance. The other adjustments, as example, the inventory is 400,000. When we come to see no adjustments for the inventory. So the inventory will go back with the same value of 400,000. In the old, this is the old 400,000. I will send it to the new also when we come to the trial, the new trial balance also, because simply we didn't do any accounts, any procedures or transactions on the inventory. So the old inventory is the same new inventory in the new trial balance, 400,000. Also, let's go and see account receivable. Account receivable 112,000. It happened adjustments on the account receivable like we did before. Prepaid rent also adjustment. Bad debts we did it created, and prepaid rent created because it was not there. We did these two rows. Account payable 45,000. Let us go and see. There was no any transactions regarding the account payable. Let us see the account payable here. How much? Account payable 35,000. Nothing, no any in these 5 operations. There is nothing regarding the account payable. So the account payable we shift it as it is. So here the account payable is 45,000 as it is, as it was, because we didn't do any transactions on this 45,000. Now we will go to the accrued expenses. They are 35,000 and 50,000, 85,000. Let us see. We had accrued expenses before. We did not have accrued expenses before. Here, no accrued expenses. So we created it, yes, because we had 2 transactions, including accrued expenses. We had 2 transactions which happened in this period of time during the fiscal year as accrued expenses. Look at this. This is the accrued expenses, and this is accrued expenses 1. This is the first one was 35,000, and the second one was 50,000. For that reason, we created accrued expenses with 35 the first one, plus 50,000 the second one, which come to 85,000 debit. Credit, sorry, credit. Credit means you have to pay it. Accrued means I took the service, I had the service, but I didn't pay. I didn't pay. Like as example, the salaries. Salaries should be paid in March. I paid it later on, after 2 months in May, on May, and so on. Now we'll go also to the equity capital. Let's see all the others, the things which I didn't touch, and it will go from the old trial balance into the new trial balance or adjusted trial balance as it is. We only make the transactions based on the number of operations which we did. So I have 5 operations, I will have 5 transactions. But each transaction affects both the sides, the debit and the credit. So it will affect on a debit and it will affect on a credit. Let's see as example the revenues. The revenue is 78 in the new one. Of course, there is nothing in the old one. It's the same. Revenues 78. Because the 5 transactions which we did not include anything regarding the revenues. Cost of goods sold, I'm expecting the same because we didn't do anything for the cost of goods sold. So we'll take it from the old one, 102, and put it on the new one, 102 as an example. Here, let's go and see cost of goods sold. Cost of goods sold, the same, 102,000. Same, we didn't approach it We didn't touch it. No transactions regarding the cost of goods sold. Now we'll go also to the next rent expenses. We did for the rent expenses some transactions. Let's see, it was 50,000. Now let us go here and see, did we talk about the rent expenses here? We didn't actually. Then here, let us go to the rent expenses. Rent expenses, rent expenses, rent expenses. We didn't touch it. It's 50,000 as it is. For the next transaction, the salary is 25,000. Let us see what happened to the salaries. 25,000. 25,000. Actually, we see here the salary is 25,000. Let's go 25,000 and 50,000 because we said those are the one which we should have to pay and we didn't pay. So here it is to the salaries from salaries account 50,000 into, so we have to add the 50,000 plus the one which was here. They will all be debited 75,000. Salaries 75,000. Electricity expenses, it was 35 in the past. Let us see here. The old transaction, electricity expenses, 35,000. Plus also there was electricity expenses, electricity bill here, 35,000. 35 plus 35, that will give me 70,000 debited. Supply expenses, 50,000. Yes, supply expenses are the same. So I'm expecting supply expenses to be the same here. Let's see here in the old one, supply expenses are 50,000. We didn't make any transactions for the supply expenses. We did not make any transaction for this. So I'm expecting that the new trial balance will also be 50,000. Let's see, this is the new or the adjusted supply. We go to the supply expenses. Supply expenses the same because no transactions occurred here for the 50,000. Interest expenses, the same thing also as well. Let us go for the interest expenses and see. Interest expenses 71,000. There is nothing on the interest. We didn't pay interest here. So here I'm expecting that the interest expenses also will be same likewise. So those in bold are things which occurred within these transactions, which occurred already. So that's the adjustments which I did for this transaction. At the end, the trial balance, the old is adjusted like you see here. The old one, debit and credit, is adjusted 938,000. New one also must be adjusted. So even though I made these transactions, but still I have to balance it 1033, 1033 at the total of the adjusted trial balance, which means in simple words that it's name even balance, trial balance. So the debit must equal the credit. For the part, thank you so much. We'll see you on the next lecture, on the next part.